standards and best practices, but those are so critical. Our regulators were saying, let's engage. If the industry creates the guidelines that we would like to work with, it's very helpful as we collaborate, so we have a good starting point. So Alan and Dan did heavy lifting on these guidelines. As of right now, we've got the whole committee has gone through. Linda and I have the last step. We do the beginning and the very end. We've got to do that. So, Linda, when do you think we'll be ready to?
Just end of this week.
Okay, end of this week. So we will share them. There's like 2 weeks for member comment, and then it goes out for public comment. And thank you, Kat, especially for your panel just now on talking about collaborative efforts, organized efforts, so it's not one-on-one barraging our guests. That's one of the reasons that EMC sits here as a 501c3, as a collaborating, communicating body, and you gave us so much to talk about, which is fabulous. Alan, do you want to do just a brief introduction?
Sure. So again, I'm Alan Schachter. I'm a partner at Cannon Gates. I work in our New York office. I actually work a lot with Henry at Flores Group. He'll introduce himself. They've been doing cannabis lending. I knew some of his team from my years as a real estate lawyer, lending lawyer, and so I've been helping them for several years. That's now shifted into workouts, takeovers, and Henry will talk about their future new fund and some really exciting horizons. So I've been in the space for a few years and happy to be part of this team, the band.
Yes, the band. The band. I'll get you in just a minute. Henry, you want to do a brief intro?
Sure, thank you. Nice to meet everybody. Is my audio okay?
We can hear you really loud.
Somebody here. Back up, see if that's a little better. Thanks for having me. Henry Miller, I'm Managing Director at Polaris Capital Group. As Alan alluded, we've worked very close together for a number of years and really value Alan's expertise on a lot of the transactions we've worked on. Polaris started initially as a pure play dedicated cannabis real estate lender in 2016 at the early end of the cycle, specifically focusing on CapEx and built out. As the industry matured, we expanded to do a stabilized lending product. And as the industry continued to mature and we started looking at the next wave, which often included workouts, we started working again with Alan on a number of different workouts, learned what was working well in businesses that continued to thrive despite price compression, increased competition, et cetera, and what was not working kind of state by state with a very data-focused approach. Then that leads us kind of into our next iteration, which is a second fund that's explicitly focused on creating enterprise value via equity investments, either into distressed or undervalued assets that we believe can be unlocked through scale. So currently manage about $400 million in assets today between both funds, and excited to be here.
Thank you very much. And Dan has been part of EMC, gosh, I think since we started pretty close. You want to do?
Sure. Hey, everybody. I'm Dan Rhoda. As Kirsten said, I've been part of the EMC Executive Council for what seems like ages. And as they do say in the cannabis industry, it's kind of like dog years. Every year in ages you approximately 7. I didn't have a single gray hair when I started in cannabis banking. So just that's my basis for comparison. But in that time, worn a few different hats that I'll talk about here today. I co-founded a fintech startup called Abaca. We were founded in my home state of Arkansas after Arkansas passed a medical cannabis amendment back in 2017. When I use the term fintech, or sometimes neobank is the buzzword, what I'm talking about there is a technology company that partners with a financial institution and really sits in between those financial institutions that it partners with and the end customer. In the case of Abaca, that end customer was the cannabis related business, or MRB. We started that business really before the big fintech boom that followed, and before that became a big buzzword. All we knew was that medical marijuana had just been legalized in our community, that it seemed like everybody and their brother was pursuing a license, and that all of the banks that would perhaps normally be salivating at the opportunity to get this new line of business in the door were just petrified. And it was just just this moment of what's going on here? Let's see what we can figure out. And so anyway, co-founded with a couple of partners, a startup that partnered with a state chartered bank in Arkansas. We began banking the industry there when it launched, grew that to a business that served about 300 cannabis related businesses in a handful of states surrounding Arkansas. Sold that company to another business in the cannabis banking space called Safe Harbor Financial shortly after Safe Harbor went public. After that transaction closed, I joined the team at Safe Harbor as Chief Credit Officer, where I got to wear the hat of being the person over our lending program for 2 years, most relevant to this panel. And in that time, I put our internal lending criteria and guidelines, credit issuance criteria in place. Launched a loan portfolio of about 60 million across, I think that was 25 different transactions in 12 or so different cannabis markets, some medical, some adult use, and certainly learned several things in that time period. I've since moved on from Safe Harbor. I'm now the Chief Strategy Officer of a vertically integrated operator called Natural State Medicinals, and so now I'm in the borrower seat. And so I've kind of sat on many different sides of the table here when it comes to cannabis lending, and as you've guessed, I have no difficulty talking about myself and these experiences, so happy to be a part of this panel, and hopefully we can share some insight with you all today.
Excellent. So we've got a few questions for our panel, but we'll take questions as long as we have time here. And you can rest assured these guidelines are very compliant. We've got a couple of lawyers here. Linda's reading through it. So we've got industry voice and law voice, which is lovely. All right, panelists, what are the biggest risks associated with lending to MRBs? And Alan, you were going to start with legal.
Sure. Well, I guess we'll start with the obvious. I mean, we've got the federal illegality is just, it's not much that you haven't already thought about, and I'm not gonna add much there. But as far as other actual lending considerations, if you're lending, and let's assume it's a secured loan, secured by the real estate, the store, or the grow facility, whatever it is, and you've got a business, and their key asset is their license or licenses. And there are different components to what is a license, and that we won't really get into here. But it's obviously their ability to work within the regulatory framework that all the state and local governments have set up. By far, as far as I know, it's all, but it's the vast majority of all of these licenses are not freely transferable. So, if you have a mortgage and you have a mortgage on this office building, if the borrower stops paying, the lender forecloses, the lender owns the building, there's no license, there's nothing really to worry about. Similarly, if they were manufacturing widgets, there wouldn't be much thought to taking over the widget manufacturing business. Taking over a cannabis business is a very, very different animal. And it's a very, very different risk profile that Henry and Dan can speak to. But it's a legal consideration. It's, this is, I'd say, question number one. Do you understand the risk, and do you understand what your exit might look like? Obviously, if borrower pays, everything works out great. Well, there's not a whole lot that I need to add to that conversation. It's when things go bad that you really need to think about it. Some other factors that we've talked about, a little more obscure. Because of the scheduling and such, and the challenges on the federal side, the bankruptcy courts are not available to cannabis businesses. And so to some lenders, that's music to their ears. To others, a bankruptcy can be an ordered process. And, a structured process for working out loans, taking over things, restructuring businesses. There's a lot of power that comes within the bankruptcy courts, the stay of litigation, the ability to set aside various contracts. All of these things do not exist in the cannabis world, and so they're tools that are not available largely to cannabis lenders. Now, there are receiverships. Some states are better than others. California has a robust receivership law, and it sort of kind of approximates a bankruptcy court, but not all states are the same. So knowing what you've got, knowing where you're operating, knowing the legal landscape, where you're operating, where your borrower operates is just huge.
Thank you. Henry, you want to weigh in on credit risk?
Yeah, I think credit risk is an expansion on everything that Alan just said. You have to evaluate every single point that he just made and do so on a state-by-state basis, because this really is 50 states that one by one are legalizing, whether medically, recreationally, or otherwise, their own cannabis programs. And while they many times are similar, each one has their own specific nuance that then fits within the nuance of each state's court system when you get to the point of a workout. So when you're underwriting the credit, you need to really fully understand the market that you're investing into and what the regulatory environment is within that market. It's also important to look at the timeline of where that state is in its legalization process. We've seen, now that we're close to 10 years into this, that there's a very similar pattern in each state that typically starts with a CapEx boom cycle, and then there's a race for market share, a stabilization period that's followed by some compression, and then a steady stabilization period thereafter. And the decisions that you might make on day one of legalization versus month 18 are completely different. So it's important to take that into consideration. And then when you're looking at the collateral package specifically for the audience here today, many of which are bankers, there's collateral that in a legal document looks secure. But then when you get to the point of a workout, because of the regulatory environment of this industry, can you actually enforce on the full collateral package? Can you take back that license to be able to replace a tenant if they fail, or to sell this building as entitled with that license? And if you can't, but you've invested on all of the FF&E that makes this a quote unquote turnkey facility, that's a potentially very risky position to be in. And then lastly, I would touch on, you have to make sure that you're also underwriting properly to the financials of the operating business within the real estate. It's very specialized real estate. And there's a tax regulation under 280E that a business that may look EBITDA positive is actually cash flow negative because of taxation issues. So you need to keep that in mind when you're underwriting to your various debt ratios to ensure that you've really got a landlord and a tenant that can pay the bill. So a lot of factors to consider.
So on that 280E, this wasn't one of the questions for Alf, so just throw it out. As a banker and a lender, not in this space prior, but that whole profitability has to change so dramatically. Do you think if, however it happens, that 280E is no longer applicable to legal cannabis, what do you think the impact is on lending, the appetite for lending, the pricing for lending?
Well, should 280E should 280E disappear, either thanks to rescheduling or some other act of Congress, the relatively immediate effect for cannabis businesses would be a wholesale improvement in their financial position. Some are, let's say, mitigating the impact of 280E to their profitability better than others. So the impact would be unevenly distributed and perhaps inversely proportional to the aggressiveness of their 280E strategies that they've been employing to date. Even so, you've got a wholesale improvement there across the board that would be beneficial, especially in light of the looming cannabis debt wall that I'm sure many of you have read about and heard about. And this impacts a lot of the larger publicly traded MSOs, perhaps most significantly, but is something that impacts cannabis operators across the board potentially, as well as cannabis exposed financial institutions across the board. A lot of the credit facilities that were set in more optimistic times are up for renewal or are just hitting a balloon and are going to need to be refinanced, and margins are compressed, rates have increased, and so those are obviously two very challenging factors. So getting 280E relief would be very much welcome for operators and lenders alike who are looking at a bit of a potential situation there coming down the road.
So that coming cannabis debt wall, Henry, I think you mentioned that when we were in New Mexico. What are the dates of that, and what happens if 280E relief hasn't hit by then?
Yeah, I may be off on the exact dollar figure, but sometime between now and the end of next year, there's roughly $2 to $2.2 billion of debt that is rolling over within the cannabis space, either needing to be paid off or refinanced. And Dan, as you said, we've got a higher rate interest environment than when most of these loans and bonds were originated. And you've got a significantly more competitive landscape in just about every state. So we view that as one part as opportunity. There's a chance to capture very attractive yields from the operators that are strong by really being able to underwrite, the best run businesses with the best management teams and capture strong yields with adequate downside protection. Or opportunistically, there's a wave of restructurings that will occur and an ability to capture value by being well positioned to navigate the legal environment that Alan was touching on a few minutes ago.
Any comments?
No, nothing to add. I mean, right. There's a lot of debt coming due, and as Henry put a number on it, and just like in other real estate sectors and other lending sectors, expect a wave of a wave of pain, a wave of restructuring, and there are going to be winners and losers. There's no question.
Well, when you said a wave, I was thinking from past lending days, a wave of bankruptcies, but that doesn't fit here.
No, but waves of default, right? And so waves of default mean enforcement by lenders, discounted payoffs, and even whether it's receiverships, foreclosures, you name it. But businesses will be trading hands.
Yeah, all I would add to that is that $2 billion figure that Henry just gave, if I just heard that correctly, that really is staggering. We're talking about something like 1/15 of the entire cannabis industry's economic impact there. So, very, very significant figure.
Which is a good segue into collateral. You've talked about real estate. In a normal retail business, you've got your coffee, big machinery. That's okay. Go ahead.
Well, so and I know Dan practices in this, so you can speak to it as well. But the lending in the cannabis world really it mimics lending in the corporate world. So it takes all different kind of forms. I know with Henry and Pelorus, we've been doing all secured lending. It's secured primarily by real estate. That's the number one asset that's looked at. It's going to be valued both as a cannabis business and as a non-operating cannabis business. We take pledges of all the assets that we can get our hands on. We might take pledges of the interest in the entities, and you're just trying to be as secured as you can. Can you get some personal guarantees from the powers that be? That would be great. But this is all stuff that so many of you, if you're lenders or regulators, you know in other lending scenarios, it's all the same things. But there are other forms of secured finance. It might just be equipment lending. It may just be to build out the equipment. So maybe it's just a piece or certain pieces of equipment. There may be a line of credit. revolving lines of credit. Kind of a scourge in the industry is the merchant cash advances. So there's all sorts of, which are secured by the receivables. And so while factoring and similar lending practices are, have a history and are acceptable in all sorts of businesses, it's become, quite predatory in the cannabis industry. So, Dan, anything to add?
I would say the three basic pillars of commercial lending very much still apply when it comes to lending in the cannabis space. Your loan to value, your debt service coverage ratio, and your guarantor support. But as Alan was just touching on, for each one of these kind of three main pillars of a loan policy, of a credit issuance framework, you've got some very unique cannabis specific wrinkles to throw you little curveballs. The biggest, and I think most talked about one, is going to be that loan to value ratio, how the cannabis value and non-cannabis value of a piece of property might intersect or interact. As Henry mentioned, in each state that has a cannabis program, you've got a different regulatory structure that has effectively created different macroeconomic conditions in each one. And one of the symptoms of that is that the methodology, the formula for valuing a piece of cannabis occupied real estate in each one of those states is going to be very different. In some states, a dispensary location that loses its permit may never be a dispensary again because there simply aren't any more dispensary licenses. In other states where there are perhaps an infinite number of possible dispensaries, looking at a structure like Florida, but there are a finite number of suitable pieces of real estate that are properly zoned and adequately distanced from a church, a house of worship, etc. If one of those were to be lost to foreclosure, you might have 5 MSOs beating down your door for it. So for the lender, those are obviously very different sets of circumstances that you need to understand when deploying capital. And while Alan mentioned there are other assets that a cannabis business might have that a lender might want to take as collateral, everything from the inventory to the equipment, the licensure laws, the laws that pertain to who can possess the collateral, whether we're talking about physical cannabis inventory or cannabis equipment, and all of these other complications really devalue the rest of that collateral package. And so for most lenders, the real estate has been really the main thing you can sink your teeth into. And so it's critically important to understand the dynamics of the state, and not just those dynamics as they exist today, but by the stroke of a pen, that entire little microcosm economic system that your state regulators have set up might be completely changed out from under them. And in a lot of cases, it's certainly not your friendly regulators who are responsible for this. The rule changes get thrust upon them and they get told to deal with it. And you guys as the lenders are just sitting back there watching, having to adjust your policy accordingly and hope for the best. So, in a lot of ways, lending to cannabis is very similar to lending in any other industry. For every way that it's similar, there's a fun little curveball too.
So speaking of curveballs, covenants for these loan agreements, anybody who's not a lending geek, the rules around what's going to be part of the loan, and Henry, you talked about this when we were in New Mexico, it's quite different, especially because it's so hard to get certain types of insurance in cannabis. Do you want to share a little bit about covenants?
Insurance specifically, or covenants in general?
For lending. For lending.
For lending in general, and Alan, I'm sure you'll want to expand on this, but I would say that covenants are absolutely critical. And there's your standard real estate related covenants, but also a number of covenants that we've found to become critical specific to business operations. And if you're not properly protected in your documents, you run the risk of being very exposed in a workout situation. Alternatively, if you do have the right covenant set up, it gives you the ability to manage those workouts in a way that really preserves the value of the assets. And when I say preserve the value of the assets, that's the real estate, but ultimately the underlying business that occupies that real estate, which is responsible for paying the rent, whether it's a third party or intercompany rent, which ultimately will pay your debt service as a lender. For example, it is a minimum of 12 to 16 weeks of cycle time if you have to take a facility from zero to a harvest. So if in a workout situation, you have a facility that's currently online, but because you don't have the ability to foreclose in a manner that keeps the license active and allows you to keep the business active, you are risking a potential dormant period of at least a quarter of operations, which also carries the expense of then restarting operations, which can be significantly more expensive. So Alan, I'm sure you want to expand on this, but I would say it's critical to have the right covenants in your docs.
Yeah, well, I couldn't agree more, but it's interesting because if you do lending or if you come from a lending background in other industries, I actually find that the covenants, and the covenants it's a promise. These are the things that you agree. The borrower agrees to do X, Y, and Z. The representations and warranties, he tells you about his business. The covenants is how he tells you he's going to operate his business, what he can and won't do, the things that the lender requires. And the reality is, from my perspective, that the covenants are very similar from industry to industry. So the covenants in my cannabis loan agreement don't look very different than the covenants in the widget making loan agreement. What do you have to do? You have to take care of the property that you own. You have to comply with all laws. You have to maintain all licenses that are required to operate the business, maintain insurance, make repairs when they're necessary. All things that are really, frankly, kind of common sense. But when you apply it to the cannabis industry, it becomes, tenfold. I mean, let's just take, again, maintaining those licenses and going back to all the regulatory stuff. Linda mentioned the culture of compliance. Well, as a cannabis lender, diligence item number one is, do they have the licenses that they need? Do they have people that know how to stay in compliance? Are they on top of this? Do they have a culture of compliance? So it's just lending 101, but on steroids.
A great way to put it.
Dan, anything? No. So we've got a whole bunch more questions here, but we'd like to hear from you all. And a couple of things, these lending guidelines, there's a QR code on the sign out front. There's cards with a QR code. There's links to all of these lending guidelines, all kinds of research and documentation on Linktree. Just pull down what you want. Coming up, there is a workout, like a business gone bad loan workout, webinar through EMC partners with the Association for Cannabis Banking, and they've got a learning management system. So go in and look at that. There's all kinds of things that we could cover here. But Cedric, did you have I know Kat has a question. Yeah.
All right, thank you very much. I've got a couple questions and I'll just name them real quick. If the first question is, do you have a license? I imagine that the process is much more difficult for folks who don't have a license. And so if you could talk a little bit about what the lending is for folks who don't have licenses versus folks who do. I think there's a challenge because we require the license before folks get capital, and folks often need capital beforehand. My second question, I know you all talked about how some of the terms in the space can feel predatory. I'm curious about what may be predatory in the space versus what's kind of common terms. And then I know there was also mention of like stock exchanges or stock market access. And so I'm curious, like what does that look like at the moment for being publicly listed? Like what does that mean in the moment for folks, and who's able to do that?
Sure. I'd like to speak to licensure for a minute there, because the question when you first sit down with a prospective borrower isn't necessarily as cut and dry as do you have your license today, but a more more complete way of asking that question might be, do you have your license or are you on a pathway to be awarded a license? Because we have to recognize as lenders that there is often a multi-stage license issuance process, and somebody might be awarded a provisional license and then not receive that full complete operational license until the facility is completed, it's built out, passed an inspection, et cetera. And so while it's perhaps less important, and everybody's credit policy is going to vary, it's maybe less important that that license be issued and in good standing as of the date that the conversation begins, or even that the loan is issued. It does need to be issued and in good standing within some reasonable time frame after that, because the lender is, of course, looking to that licensed business to operate, generate revenue that's going to be used to pay the loan. And so that's where it's important for a lender to understand a state's process. In some states, that the award of licenses might be a one-time thing and very finite, and so you have a very limited pool of prospective borrowers. In other states, it's a bit more open, and so it's incumbent on the would-be business operator to put that financing in place perhaps before they can get awarded a license. And that's where it's challenging, and it's challenging in cannabis just as it's challenging in most other industries for a business operator that doesn't have other ongoing business operations or business assets to draw either revenue from or collateral base from to take to the bank and look to leverage that to get additional credit to go open or expand this new business. And in most other lines of business, if we were talking about an HVAC company or something like that, a prospective business operator, even one with pretty limited experience, would be able to go to the Small Business Administration or the state equivalent. Well, as I think you're all aware, that's not a pathway that is available to cannabis operators. That's been a challenge. We have seen some state agencies step up and try to fill the gap there, some better than others, but that absolutely does remain a gap, because conventional financial institutions are going to continue looking at cannabis businesses in much the same way they look at other businesses, where they're going to look for, if not revenue in that business, revenue support from related businesses that can be collateralized, as well as perhaps unrelated assets to be collateralized. And if those aren't there, it becomes hard for that borrower to figure out, for that prospective business operator to figure out, where do we start? How do we get in here and get involved? So, you know, it's certainly a challenge, and that's one of the areas where perhaps in a post-legalization world, you would see some of those boundaries start to break down, as SBA loans and things like that would be more available.
Yeah,
Yeah,
so I
Charlie.
think, well, one I think is fairly simple. I think I can answer it briefly. The stock market. So there are several companies. So it's illegal at the federal level, and so the SEC doesn't sanction it. There are no U.S. companies listed on any U.S. stock exchange. However, in Canada, it's legal. Internationally, but you don't need to go beyond. So, you know, we've had California businesses that are listed on the Toronto Exchange. So they're able to trade and raise money that way. I mean, it's not a very healthy market today, but several years ago, that was, you know, all the rage. And the future of listing in the U.S. is like 280E and so many other related things. So we'll see what the future of that is. As for predatory lending that you asked about, you know, I think it's a function of, for all the reasons we've discussed, it's so hard for cannabis businesses to raise money. And while there are lenders and there are avenues for raising funds, it's harder. It's harder to turn a buck because of 280E. It's harder there are just fewer sources of capital, other traditional, whether it's SBA, whether it's going down the block to Chase. There are just fewer lenders out there. They're often cash starved, especially in today's business environment. It's the businesses many are not doing as well as they might otherwise have been doing. And so into this vacuum steps people with cash, predators, who charge exorbitant interest rates and take advantage of borrowers that are perhaps not quite so sophisticated, and they're kind of handing away the keys to their business without really understanding what they're doing, and they're getting in deeply in over their heads. I know, Henry, you've got, more than enough stories or anecdotes, and I don't know if you want to add anything, but, I think that's the basic idea.
Yeah, I think you hit the nail on the head in terms of the market environment that creates it. But as a lender, I think it's important, and when we talk about having your documents, that you add provisions that prohibit that type of lending, and that when you are closing, that you make sure that there's none of that type of lending on the books. And it's important to look at because sometimes they can be disguised as payables and not technically classified on the balance sheet as a loan. So you need to run the UCCs on the assets and entities, very diligently, and check and double check title to make sure that you are protected as a lender from some of these events. And just one other thing to add, going back to what Alan was saying about the exchanges, the rate environment has increased as the market has faced its own competition and challenges, which has sort of starved it for capital. The U.S. market is still limited from the U.S. major exchanges due to federal legalization, and as a result is on OTC or the Canadian markets, and are not able to access the liquidity that exists on the major exchanges. So we do believe that if there ever is a period, and I've been in the industry long enough that I don't underwrite to this and I don't bet on a date, but if we have rescheduling or a change in policy that allows for U.S. operations to be listed on either the NASDAQ or the New York Stock Exchange, for example, we expect the valuations will see a dramatic pop, and there'll be a significantly increased availability of capital, both on the equity and debt side, for businesses to tap into.
Very cool. We got 2 minutes. We're going to be on time for break, but very quickly, you all just made the point for why we need industry-driven lending guidelines by the good guys. Because as a lender who's been watching what goes on out there, there is some really goofball, predatory stuff, and too often the leadership of the cannabis businesses come and say, "Hey, I just signed this. Will you read it?" Well, that's not very helpful. So the lending guidelines, they're there for all of us, the regulators, the lenders, and the cannabis businesses, to be the good guys and to help shine a spotlight. Here's what's good. If it doesn't have this, then don't sign it, or ask a lawyer before you do, so you don't get into that. All right, we've got break. Please come back on time because we are packed with really cool stuff. And Kat, you've got the next panel. So thank you guys. Thanks, Henry.
Thanks for having me.